morning, investing community. I'm Carly. I'm the relationship manager at Easy Equities. And today we are speaking about one of my favorite things, and that is ETFs. And for those of you who don't know what that means, it's not an extraterrestrial being as in ET. We are talking about exchange traded funds. I'm joined today by some awesome peeps. I'm going to introduce you to them now. Let's start with Mikado peeps. I've got Lisa and Gerrit that are joining us as well. They are Easy Equities users just like you. They're a little ETF crazy, which is why I thought, let me bring them into this conversation. And also we've got an expert, Nico Katz. And he is from Satrix. He's the head of portfolio solutions there. I was reading his bio, and I mean, there's words there that I can't even pronounce. That is how smart this guy is. He's got degrees coming out of his ears. He does research and insights, and he even offers guidance on some of the portfolio construction at Satrix. Satrix, of course, in the spotlight today. Satrix is an ETF provider. They've been around for over 20 years in South Africa. They've got an amazing spread of ETFs, all available to invest in by Easy Equities. And so, yeah, today we are talking about one of the most popular ETFs in the spread, the Satrix Top 40. Drum roll. Yay, we're going to get into it today, guys. So I think what I'm going to do is let's talk ETFs first a bit generally. Let's get into it. What is this thing called an ETF? So for those of you who've never heard of an ETF before, essentially what an ETF is, an exchange traded fund, is a way for you to invest in a collection of shares or a collection of companies that follow a specific theme. So today's is the top 40, which is the top 40 South African companies by market cap. We'll get into what that is in a moment. And the cool thing about it is that you can invest in all of these companies with one transaction. So one transaction and you get this bunch of companies. What else is super cool about that is we're always hearing about how important it is to have a diversified portfolio when you invest. Why? Because it just protects you against the risk of having all your eggs in one basket. So when you invest in an ETF, boom, automatic diversification. You've got a portfolio of all different shares from different industries, potentially, especially with this one, that is the case. And so I think that's a really awesome benefit. So maybe now I'm going to just invite some of our guests to join before you guys get sick of my voice. Impossible, I know. Yeah, so I want to talk a little bit first about what I just said about ETFs, diversification. Nico, maybe do you want to jump in and talk a little bit about that? Why ETFs rock, basically?
Yeah, thank you, Carly. Like you mentioned, I mean, I can't do a better introduction to what an ETF is than you did. It's really a great investment vehicle for investors that do not have the time or the expertise to manage their own investment portfolios. So as picking stocks is complicated and time-consuming and can be risky and quite costly to do on your own. So I absolutely count myself in this bucket of people that that benefit from ETFs, from investing in it, as opposed to picking stocks individually. And I make full use of index tracking funds for my own investments. It's through our simple online platform, Satrix Now. You can invest with no minimums and set up a recurring investment contribution to invest on a monthly basis. So as you were mentioning diversification, I mean, that's one of the most important aspects to investing is consistency and diversification, spreading your eggs across different baskets, and then finding that investment vehicle that is low cost and meets your needs.
I think you mentioned such a good point. Like, when it comes to making that first investment, Lisa and Gerrit, like, how intimidating is that decision? You just starting your investment journey and you're like, okay, there's like 400 plus companies now. Which one is the one for me and how much do I invest in it? But with an ETF, it takes that kind of confusion or that decision-making aspect out of it because you've already got the set of, essentially a little portfolio of companies already put together for you. All you need to do is decide an industry or a theme, right? I mean, what do you think about how tell us about you guys. Like, how did you get into investing and how did you choose your first investment?
Well, so specifically for me, Carly, I had the fortunate opportunity of sitting in a discussion with Stealthy Wealth, and I don't know if a lot of people know him, but he's a finance blogger. And from reading all of his different posts, I realized, okay, well, I'm not going to be good at picking stocks, so I might as well just leave that. I don't have all of those insane degrees that Nico has, so I'm not even going to try and attempt to pick the stocks, but I could invest in the market by means of a simple low-cost ETF. And as you mentioned previously, the top 40 was a great investment opportunity, so I just decided to buy ETFs. And yeah, that's how I got into it.
For me as well, it was the same thing. I feel like when I got my job, I was like, okay, I guess I need to start investing money. I guess this is what adults do. And then all of a sudden you hear of all these things and you hear of all these massive names and you're like, what is anything? I don't understand anything. So an ETF makes it so easy. And as you said, it's not expensive at all. You get access to multiple companies that are really amazing companies as well. So you know you're going to be okay. Whereas if you have to do this by your own and invest in companies that you just have absolutely no idea how does it work? How do they work? How do I get my dividends back? All that stuff is just very confusing when you're young and you don't have any experience. So for me, an ETF was just it was like, why not? And I haven't looked back since. I love ETFs. I only buy ETFs. So yeah, maybe that tells you something about ETFs.
Sounds like you're as obsessed as I am. It's fine. I won't tell anyone. So I want to hear a little bit more actually about your investing journey, and just like, you know, you guys are a lot like me, I guess, and a lot like so many people in our community. You're still kind of figuring things out as you go. I know I am. I learn something new every single day. So I wanted to ask you guys, what would you say to someone who's just starting their investing journey right now? Like, what kind of tips would you give them in how to kind of figure things out for themselves? Because I really believe that everyone is capable of investing for themselves. That is, you know, where Easy Equities is really born from. It's about empowering you, educating you, and giving you the confidence to do this. I mean, we do have these extremely low fees and low barrier to entry. That's great. But, you know, what would you say would be helpful things to know when you're first starting out?
Well, in my case, it was definitely just read up as much as you can. So there are a couple of really simple investing books that you can read just to get a feel for everything at the end of the day, Collie. So when you start off, as Lisa said, there are a lot of complicated terms that everybody speaks about and things you don't understand. But when you start breaking it down piece by piece and start listening to podcasts and reading some books, you really start to understand the terminology. And once you understand the terminology, you realize, as you said, that it's not really that difficult to manage your own finances. And that's essentially the biggest part, is educating yourself in the start, and then just start investing. So form the habits of actually putting the money away every single month.
Yes, exactly. I'd like to add to that and say, yes, you need to educate yourself and all that stuff, but also you need to just relax and also just realize that it's not that big a deal. Because I feel like now we have an app, Easy Equities, and it makes it so easy to invest. Easy Equities, it makes it really easy. But whereas like a year ago, maybe 2 years ago, in my experience, it was just this massive, heavy, overwhelming thing. So I think my advice would be to any individual is just like, educate yourself, but just realize that there are so many ways to invest that makes it easy. And you can invest R1 if you want to. I don't know if that helps, but you can invest like R100 on Easy Equity. So you don't need a lot of money to be an investor. It's not that you need all this money. You can invest what you have, and that in itself is just awesome. If you just invest what you have, it does not have to be a lot, and it's not that hard. It's very easy. So yeah.
Okay, so let's get into it. The Satrix top 40. I'll start with you guys, then I'm going to ask Nico to give us the nitty gritty. But I wanted to ask, can you name a few companies in the top 40, maybe some of your favorites?
Well, we can go with Anglo. He works at Anglo, so maybe that's a good one to name.
Yeah, it's all the big companies, isn't it? It's like Anglo, it's the Naspers,
international companies, actually. Yeah,
massive international companies. So we have got a lot of miners in there because obviously South Africa has a massive mining sector. So you can basically include all of your different mining companies in there. And then you've also got a couple of, what are the other important companies? You've got a couple of financials inside.
You've got all that massive
financials,
banking companies that will make money, will always be making money. Yeah, I feel like here and there we've had upsets, of course, in the last year with everything that happened. Of course, we had a couple of like, oops, what just happened? But I feel like when you look at the companies in there, most of them are massive, huge international companies. And I think that is why I love that ETF that much, because yes, it's South African companies, but they're all over the world. So you know that they will make money essentially in the future.
I think that's great. And that goes back to what I was speaking about diversification. I mean, you're talking about all these different industries, the financial industry, there's a retail industry companies in there, there's mining companies. And so even if something specific had to happen to one of those industries where it took a knock, you'd have the other industries to kind of help mitigate that risk, So that's a really cool point. But now I want to get stuck in. Nico, let's talk about the companies in this ETF. Why are they in this ETF? Who chooses what gets put inside an ETF? And then how often do they change, or do they stay the same all the time?
Great question. And just to get back to what our guests are also saying in terms of saving and investing, I think it's very important just to, before I get into the nitty-gritty, just make that distinction that it's incredibly important to both save and invest. And oftentimes we think of it as being the same thing. But what the recent pandemic illustrated is the importance of setting aside money for unintended events, like a global pandemic, which no one saw coming, right? So the importance of consuming less than you earn and saving accordingly, but then also to help sort of for a rainy day, but then also investing. So in other words, growing capital over the longer term. So setting money aside, doing so consistently, and finding the right investment vehicle for yourself that is sufficiently diversified, but also has low costs. That is how you create wealth over time.
Are you saying I need to start controlling my shoe habits?
I think of investing very much as exercising. It's an incredibly hard habit to start doing. Every year I tell myself, this year I'm going to start gymming and running and cycling, but then you reach March or April and you look at yourself and you go, I didn't do that, right? And investing is very similar. We know we need for our capital well-being, we need to set money aside and do so in a way that grows capital. But it's about getting that habit right. And what Satrix now, the platform, actually enables our clients to do, and we are equally as passionate as you are about investing, is it allows you to set, for example, a monthly recurring contribution to an ETF, which means every month you're putting money aside. And just how I do it, I take a certain amount every month, and on the first of the month, I put money away. I invest it out of sight, out of mind. I don't think about that, and it forces me to invest. If only exercising could be as simple. So if we get into the nitty-gritty stuff, so index funds like the Statrix 40 ETF we are discussing today, really aims to simplify the process of investing in public companies by following simple and transparent rules in our construction. So the money you invest in the Satrix 40 ETF is used to buy the largest 40 companies listed on the JSE. So practically, this means that you hold a basket of the largest publicly listed companies in South Africa by simply buying one asset, which is an exchange-traded fund or an ETF, which trades on the JSE very much like any other share. Now, in this ETF basket, companies are weighted by their size. So implying that if a company is larger than another one, you will hold more of it. So to illustrate this, I've prepared a figure that I want to show you. If I can just share my screen. And you can just tell me if my screen has been shared, Carly.
Yeah, we can see it.
Okay, so as you can see from the screen that I shared, this is the companies that make up the top 40 index, and I've created this slide so that the size of the company in the label more or less reflects how much of the company you are holding. So you'll recognize most of the names of the companies on this list, which implies you can have peace of mind that your hard-earned income is invested in companies that have a well-established track record, as our friends from Cato has suggested. So to give you a sense of where your money... Yes.
Nico, instead of buying shoes at Mr. Price, if I invest in this top 40, I'm essentially getting a slice of Mr. Price anyway. I'm actually contributing in a bit of a better way.
Absolutely, and it's that part of investing that there's a beauty in that as well, in that you own the companies that you are anyway spending your money at. So if you look at this basket of stocks, for every if suppose you put 100 Rand into the Satrix 40 ETF, you would hold roughly 20 Rand in Naspers shares, which gives you fantastic exposure to their portfolio of global fintech companies. Your 100 Rand would also buy approximately 23 Rand of BHP Billiton and Anglo American shares, which are both massive international resource companies with oil, gas, and precious metal mining operations on nearly every continent. Another 10 Rand would go into Richemont, which sells luxury good items like Cartier or Montblanc. And these four companies, which make up the majority of your portfolio, derive much of their income from overseas, meaning that you get good Rand protection for the 100 Rand that you invested as well. You'll also hold about 10 Rand worth of banking shares, so your Absa, First Rand, Standard Bank, Investec, Capitec, all of them are there. And your 100 Rand will also buy a range of other household name retailers. So for example, about 17 Rand would go to companies that include ShopRite, Clicks, Woolworths, Bidvest, Mr. Price, Spar. You'll also see names like MTN and Vodacom, as well as Sasol, which, if you take all of this together, indirectly means that you benefit from the companies you use to store your money in, as well as where you spend it. So in other words, the 100 Rand invested in the Satrix 40 ETF is well spread out and offers investors a wide variety of exposure to different companies at a very low cost. Now, this truly a remarkable product that's been around for more than 20 years, really helps you uncomplicate the investment process by buying a single instrument that offers you a great diversification.
Nice. Okay. So now we know what's in here. Let's talk a little bit more about cost. So what kind of costs are associated with an ETF? We know that if you invest via easy equities, you pay 0.25% brokerage on any investment that you make. So what else is there for people to be aware of? And I think it's interesting to look at an ETF, and then considering that that's a portfolio in itself, how does that even compare to other things like a managed portfolio by an asset manager? There's more traditional ways of investing that some people use. So maybe talk a little bit about that if you can.
That's a great question. And it's a very important question that all investors really need to ask themselves. What am I paying when I am investing? So to answer your question, we typically look at the TER, or the total expense ratio, which measures the total cost associated with managing an investment fund. Now, this includes management fees, regulatory compliance costs, auditor fees, and various other operational expenses. It is calculated ultimately by dividing the total fund cost by the fund assets to give you a percentage cost that you are paying effectively per year. Now, as with anything else in life, investing does not come freely, but index funds like the Satrix 40 ETF typically have a much lower management fee as it follows a very simple construction process and rules, and also typically has lower trading costs, simply because we need to trade less. It's interesting if you think about it. Einstein famously said that compound interest, or interest earned on interest over time, is the eighth wonder of the world. Now, in the same breath, we can think of compounded fees as being equally destructive over time. In fact, I prepared a little figure that I want to show you guys, just to also give you a sense of just what this fee impact truly does to your portfolio. Before I get to what the fees are on the Satrix 40. So from this figure, if you can see there, I'm not sure if you can see it, but if you invested 1 million Rand in the top 40 index right after its inception in December 2000 and reinvested your dividends, because that's also an important decision to make. You want the dividends paid out or reinvested. Ideally, of course, if you're looking to invest long term, you should be putting your dividends back into your investment portfolio. If you invested that 1 million Rand back in 2000 December, your initial investment would have grown to just below 14 million Rand, which is a fantastic return. If you paid 0.1% fee per year, which is what the Satrix top 40 ETF has a TR of 0.1%, you would have accumulated roughly 13.7 million rand. Now, as the fee paid increases, you can see the dramatic impact it has on your overall returns. Paying in the range of 3.5%, which many investors do, considering the fact that you have management fees, advisor fees, brokerage fees, various other fees that add up to making the total investment charge even greater. Then if you paid 3.5% fee per year, you would have ended up with accumulated wealth of just below 7 million rand. Now that's incredible, right? So the difference between paying 0.1% and 3.5% is that you have halved your accumulated wealth over this 20-year period. So a lot of investors would have actually been happy looking at their investment portfolio and seeing that they made 7 million rand over this period. But that ignores the fact that they should have really earned double that amount before fees. And so it just again underlines the importance of paying low fees and ensuring that the fees that you pay are transparent, that you know what you're paying, and if there's layers of fees, to try and mitigate those layers of fees. So as our friends from Cato suggested, they do their own investments, and you can do so using Easy Equities or the Statrix Now platform, which helps you buy individual stocks, but it also helps you buy ETFs like the Satrix 40 ETF, which you can think of as a single stock, but think of it more as a basket of stocks. So it trades like a single stock. You buy a single unit of it, but it represents a diversified basket of stocks. And the fee on that, or the total expense ratio, is 0.1%, which puts it on a league of its own in terms of low fees. Carly, you also mentioned other actively managed funds, so Coronations, Alan Gray's, etc., names that you would be aware of. A lot of these actively managed funds typically have fees in the region of 1.4 to 2% fees, which, if you think about it, is about 14 to 20 times higher than the Satrix 40 ETF. Other similar ETF, absolutely. Other similar ETF structures tracking the top 40 index pay in the region, you'll pay in the region of 0.13 to 0.35%, which makes our top 40 ETF amongst the lowest in the market, if not the lowest. Which really, if you're paying more for a different top 40 index tracker, you should really be asking yourself why you're doing so while you're getting the exact same product.
I want to quickly get some input here from our Cardo team. Guys, how often do you look at the fact sheet when you're investing in your ETFs?
I looked at it, well, the first time, essentially, Carly. So in the beginning, you decide, okay, what's my strategy going to be? What are the ETFs I'm going to invest in? And then first up, I'm going to invest in the fact sheets. As I mentioned, I had the fortunate opportunity of speaking with Stealthy Wealth, and he outlined the importance of the fees and looking at the TER. And then after those discussions, I specifically went to all of the different funds that I was going to buy, and I looked at the fees before making my purchase. So exactly like Nico said, I bought the top 40 because I saw it at the lowest fees as compared to all of the other providers.
Yeah, so I mean, if you guys have never heard of a fact sheet or don't know where to find it, if you go onto the platform, you'll always have a link to a description about the ETF, and you can have access to the fact sheet. And the fact sheet gives you, it's like the CV of the ETF. It's like, this is what I do, this is why I'm good at it, this is how much I cost. It'll tell you everything you need to know about that specific ETF. And I think when it comes to deciding, okay, do I go for this ETF or that ETF, it's such a valuable tool because you're able to kind of look at both and measure them up against themselves or each other. Another great way to do that, if you're like, okay, I'm sold, I'm in ETFs, where do I go? Like, I want to find out more, compare them, see what everyone's saying about them. You'll want to check out a site called Easy ETFs. Essentially, it's an easy equities platform, but it allows you to compare different ETFs and see what the different tiers are, see, you know, how they measure up against each other. So that's another valuable research resource that you can look at.
Yeah, and I think another thing that might be interesting to elaborate on is the MDD as well. Is also very helpful. MDD, right? Yeah. So it's not the exactly the same thing, right? Is it, as the fact sheet, Nico? Is there a difference between the two, an MDD and a fact sheet?
Thank you. So the minimum disclosure document is basically, as fund managers, we need to or we are regulated to open up the hood, if you like. So you can see what we're investing in, what fees are being charged. And it's also important just to note that ETFs are regulated in exactly the same way as unit trusts are. So a lot of the listeners would be comfortable with the term unit trusts, and they've been investing in unit trusts for a long time. ETFs are regulated in exactly the same way by exactly the same regulators. So there's no difference in terms of regulation. We are also required to have minimum disclosure documents that details all of the information, what stocks we're investing in, what benchmark we're tracking, what fees we're charging, etc., etc. So you can always look at that and request that from whichever platform you're using to do your investments. And I would definitely recommend that. You know, that's one of the first things you should be looking at is where am I putting my money, as well as what am I paying. I've you know, just casually, I've anecdotally rather, I've come across so many people that focus so much on their income and ensuring they earn the maximum amount that they can earn. But what they do with that earning, with those earnings, they almost, you know, don't even give it a second thought. So you think that over time, how you build capital is by ensuring that you earn the maximum amount that you can. But really how you earn capital is by being productive with the money that you make. So as the figure that I showed you, over a 20-year period, I mean, you took 1 million Rand and you made it 14 million Rand. That's how you earn capital over time. And that's why these investment vehicles like ETFs really facilitate that journey. It helps you both getting onto the journey of building capital by being easy to buy, as well as providing you with good value for money, low fees, and full transparency.
So guys, we've got some really great questions coming in and I want to get to them. So I've just got one more topic that I think we should cover. And that topic is, who would be suited to invest in this ETF? I mean, we know that all investments carry some degree of risk. And, you know, as we've said, there's ways to mitigate that as well. But is there, you know, a certain time horizon that someone should have in mind? Is it, you know, what kind of risk appetite or what kind of investor would really suit this ETF if they were looking for something like this?
So I think the type of investor that would best benefit from an ETF is the type of investor that, like our friends from Cato, like to do their own investments. So they like to you know, have full control over what their money is going towards, what they are earning, what they are paying in fees. And for those type of investors, ETFs are great products because they are transparent. You know what you're getting. And as with other things that you purchase in life, we want to know what we buy. So ETFs are just great from that perspective. It's also a great tool for those of us that don't have the expertise to manage our own investment portfolios. And a lot of us, you know, feel that picking stocks is complicated and time-consuming, like we mentioned, and it is not for everyone. And they, you know, having a simple product that gives you a very good diversification, basically a basket of shares bought by buying one share that trades on the JSE, that's sufficiently regulated, is a fantastic solution for most investors. And I don't want to single out one particular type of individual for whom this would benefit. I really want to include all South Africans in this bucket to say ETFs really should be considered by everyone as a part of their portfolio. Of course, I do have to stress there are risks involved when investing in equities, so it's not a one-way return stream. It might seem so if you look at it over a long term that, you know, it only goes one way and that's up, but that's not the reality. In fact, we do have risks involved in investing in equities, but that's where ETFs try and mitigate those risks by forcing you to be diversified by the fact that you are buying one instrument, but that one instrument has already built-in diversification. I would never recommend that someone goes and identifies one or two stocks, and you know, because that's not investing really, that is speculating. So investing in an ETF is spreading your bets, and it is allowing you to invest for the long term as opposed to speculating.
I like that. Everyone, you're all qualifiers to invest in the Satrix Top 40. It's a great ETF. Go read about it, check it out, look at the fact sheets. And now I'm going to take a couple of questions. There's some goodies in here, I've got to tell you. This one is a question that I even have for you, for all of you guys. should you have multiple Satrix ETFs or focus on just one or two? I have 3 active Satrix ETFs and I'm never sure which one to fund more than the other. Therefore, I keep them all one equal amount. And I sort of follow the same strategy personally. As you guys know or may not know, ETFs qualify to be invested in your tax-free savings account. And I'll make sure that I drop a little bit of information on that in the description below this video when we post it. But yeah, I've got Satrix ETFs in my TFSA and I'm like, do I get more? Do I keep one? What do you think of that, Nico?
That's a great question. Personally, I hold a few, you know, and I think it again speaks to the value of diversification. Because if you think of the top 40 index, it's a great diversifier locally. But what we also offer is ETFs that give you global exposure. So we have the S&P, you can invest in the S&P 500, the NASDAQ 100, the MSCI Developing Market Index as well. You can also invest in bonds. So there's different asset classes, different regions. So spreading your bets is a great way to ensure that you are investing optimally. The age-old adage, and I think you mentioned it at the start, that you should not put all your eggs in one basket. That's absolutely true, but it's even a bit more nuanced than that. You should ensure that your eggs are in uncorrelated or different types of baskets. Because if all your eggs are in one basket and that one basket is on one truck that crashes, you know, there goes your eggs. But if your eggs are spread out, so for example, if you hold some domestically, some in bonds, some in you know, in the S&P 500, for example, if one market corrects or one asset class corrects, that implies that you have some benefit as well. So my recommendation would be buying a few ETFs across different asset classes or different jurisdictions or regions, and we offer all of that. So we allow you to build a diversified set of ETFs that, you know, spread your bet. So I fully agree with the person asking that question, and I myself buy a few ETFs. I don't think that buying one single ETF is necessarily the solution for everyone, but you know, it's all about diversification.
And Cardo kids?
Sorry,
would help if I asked the question out loud. Tell me, how many ETFs do you guys have in general? Do you have one or do you have a handful?
So,
3.
yeah, in between us, we have a couple. We don't invest in like the same stuff. He often has a look at my Easy Equities account. He's like, why did you choose this one? I'm like, listen, don't do that. But yeah, so we have a couple of ETFs. So we don't just have one. You wanted to say?
Yeah, so specifically for us as well, like I have 3 different Satrix ETFs, and it was all based on a research that I had done. So I knew from the beginning, okay, I wanted to have exposure to the global markets, but I also wanted to have local exposure, but I also wanted to have exposure to emerging markets. And with 3 simple Satrix ETFs, it was really easy to do that. And maybe to add to one of the questions that you had, Carly, was how should I allocate all of my different funds? For me, it was simple. Like I had no clear reason why I should invest in the one versus the other. So I just split it equally between all of them. And that's how I basically do it. I automated split it between the 3 of them, and then that's what I do.
And I think it's important to note that everyone's different. Everyone has different goals. And so you've got to find something that works for you. Okay, here's a good question as well. Once I invest in the Satrix 40 and a company falls off the top 40, like Steinhoff, for example, what happens? How does that impact the ETF? Nico?
Okay, so sorry, can you hear me, Carly?
Yep.
Okay, so maybe we just need to explain how the weights change in an ETF as well. So an ETF like the Satrix Top 40 rebalances every quarter, so in line with the JSE quarterly rebalancing. So if a company like, for example, Steinhoff falls off a cliff, loses 90% of its value, you know, within a week, and it becomes too small, so it's no longer part of the top 40 or the 40 largest companies. At the next rebalancing, so at the next quarter rebalance, the JSE will revisit the company's sizes and will re-rank the companies by their market capitalization. They'll also look at which are the 40 biggest stocks. And if a company has fallen out, then that will fall out of their list. We as an index tracker simply look at that list and apply their methodology. So we just look at that and we say, right, Steinhoff is no longer part of that portfolio. So we would then sell Steinhoff at that quarter. And then if another company comes into the top 40, like let's say Exaro, we would then sell Steinhoff and buy XRO. But the beauty of that is as well, and it's important to stress that, is that because it rebalances so infrequently every quarter, it means that we're not actively buying and selling stocks in the interim, which keeps our transaction costs down. If you look at a lot of active fund managers, they do buy and sell companies quite a bit in order to find the winners and the losers. And again, globally, it's been shown that active managers do not have the best track record in identifying the winners and losers. So this bidding up of transaction costs over time, again, adds to your costs. So by keeping transactions to a minimum and then rebalancing every quarter and reconsidering which are the 40 largest stocks, we keep costs down even further.
Okay, so on costs, you spoke about TER earlier, the total expense ratio. When you purchase an ETF, is that TER built into the price when you buy? How does it work with that? How does it come off? I don't know. Yeah, can you explain how that works a little bit?
So as I mentioned earlier, the TER is basically where we have the total costs divided by the total number of assets, and that gives you a percentage. So it gives you an indication of what would likely be the total expenses that is charged, incurred by the fund. And remember, it's important to also consider that it's not only management fees that are charged. There's a lot of additional expenses that we also have to take into account. So while a TER is a fixed number, that's something we aspire to, and if you look at the total investment charge, that might be a bit more than the total expense ratio, simply because there are other cost components involved to consider. But safe to say, you can look at the TER as a general reflection of the annual fee that you can expect when you're buying an ETF.
Okay, cool. Now this one, Cardo guys, or Nico, either of you can jump in because I think maybe Cardo, Lisa, you can maybe chat to this because you spoke about it just now. Does the MDD provide the same information as the fund fact sheet? Are they the same documents or are they different?
So my understanding is that they're not the same documents, and that the MDD is a regulatory document, but I think you can use either one if you want to have a look at how much you pay. It invests in XYZ is on both of them, if I'm not mistaken. Nico, he's the professional here, so I think he should just help me if I'm wrong, but I think it's more or less the same document in effect. Nico?
Yeah, so an MDD is a regulated. So a fund fact sheet really is the same thing as an MDD. Ultimately, it comes down to the same thing. It's basically a document about a fund offered by an investment company, which is regulated and monitored by the FSCA, or the Financial Sector Conduct Authority. So the requirements are outlined in regulation, and each month whether it's a unit trust fund manager or an ETF fund provider needs to provide this minimum information to clients. You might also see a different information sets provided to clients in terms of that's more from a marketing perspective to sort of explain what you can expect. But an MDD is really what you should be after when you're looking at the minimum requirements, regulatory requirements that needs to be given to investors. So it basically just ensures that you as the ultimate investor know what you're investing in, and it's just these documents are really it's designed to be readable and interpretable by non-investment professionals as well. There might be some lingo that might be new to you, but if you look at the glossary, you should be able to understand them. And of course, you can either email us directly or ask a financial services provider if there's anything on an MDD that you're uncertain of. So a minimum disclosure document simply facilitates the openness and transparency that fund managers have to adhere to.
Okay, last question for the day, and it's a good one. It's a bit more of a general question. The question is, in my tax-free savings accounts, I've got a 36,000 Rand annual contribution limit. is it better to leave that 36,000 in my tax-free savings account to earn interest, or should I invest it in ETFs? Is that too risky? Matter of opinion. I'll give you mine. This is my one question I'll answer. I would say you're crazy to leave your 36,000 in your account earning interest. That's my personal opinion, because when you invest in ETFs, if you have a look at, for example, the performance of an ETF over the last 10 years, and you see what percentage return that's offered, and you compare that to the rate of interest or even inflation, if you had to, leave it in a savings account, you'll see that, most times, and certainly in my personal account, you can't even compare. And I think when you have a long-term point of view, which I really recommend for all investors, don't look at this as something you're going to see your returns on tomorrow. If you have a couple of years, the longer the better, 10 years, 30 years, as long as you possibly can wait, in my opinion, then you're going to see those returns just building and building year on year potentially. And I don't feel that you get that same experience if you're just looking at interest. So that's my opinion. I'm sure you guys will all agree with that. We're going to end things off there. I just wanted to say a huge thank you, guys, everyone who watched. If you are a nerd like me and you want to go back and re-watch this and get the highlights reel, we'll be posting this on our social media platforms, so look out for that. Thank you so much, guys. Thank you, guests. Thank you, Niku. Thanks, Lisa and Gerrit. You guys have been rock stars. Yeah, can't wait to hang out with you again soon. Thank you so much, everyone.